Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Incredibly important. Somebody said like $10 trillion or some ginormous number. Is a ginormous excellence. Julian Emanuel joins as Chief Equity and Quant Strategist, Evercore ISI, with a definitive note. What's distinctive about your daily research note that your team writes for you? We know you don't write it, but what's distinctive about the note now versus the other previous quarters? OMG, earnings are better than we thought.
That's the headline, Tom. And the reality is it's broader than you might have thought on balance, right? We know tech's going to beat. Tech has beaten. It will continue to beat.
Right.
But one of the more maligned sectors, energy, is also showing very consistent beats, as is financials, which was the story that started us off on what is likely to be double-digit earnings growth.
Bring it over to all the heritage of Ed Hyman, Evercore, and frankly, ISI, and frankly, Evercore. Is this just because GDP was better than we expected? I mean, is this just a real or even nominal GDP pop that's helping out broad earnings?
Well, that's certainly part of it. It's also this idea that the stress from tariffs has sort of dissipated through the system in unseen ways. But again, it is the story of what it's been certainly the 3 years of this bull market, and going back further than that, is that every time you think that corporate America can't find a way to make margins, better or at least stable at these high levels, productivity tends to happen.
It tends to happen. You're right. I mean, don't underestimate the corporate entity out there or the consumer. Where do we go here from the stock market? I'm guessing a lot of the questions you get from your clients is, boy, it feels rich here. How do we think about it? Where do we go from here?
So it does. And frankly, when you think about the wall of worry, we like that because that means there is a wall of worry. Yeah. I will say in the last week or so, the fact that September and October were as positive as they were have gotten people very, very bullish. And almost rightly so, because seasonality tends to be good in November and December. But when you think about all this event risk, geopolitical, monetary, earnings, elections, etc., there may be a step back in here. But again, the story of the long-term story, the AI-driven bull market, as we've seen by the news flow in the last 24 hours, is largely on track.
What do you make of gold? What a run that is pullback that is. I don't know. What do you make of gold here?
We think actually, so a lot of our conversations this summer and the fall have been about bubbles in the market, in the stock market. We think you're a long way from that in the S&P 500 and in the AI story. But gold could be the bubble that has burst in our view. Because if you think about it, the same reasons that people were buying gold, fear of inflation being more permanent, that is not coming to roost. It's still too high, but it is on track to come down in 2026. And then this whole idea of the debasement trade, the quote-unquote debasement trade, we'll call bunk on that. Because if you think about it, A, the dollar has been very stable the last several months.
Right.
B, yields are low.
That's right where I want to go. Julian Emanuel with us, folks, with Evercore ISI here to set up the earnings season. Let me take the 60,000 macro view. I'm looking at the screen this morning, and I see a jump condition, and it's because of Donald Trump. He's over in Asia. He's getting, as he would say, deals done. I have a 3-day jump condition in renminbi strength. I got sterling flat on their back as well. Sum the Evercore ISI view into your earnings belief for Q1 of next year, for Q2. Does this every 90-day idiocy? OMG, earnings, we thought they'd be terrible. They're doing phenomenal. Do we just continue this bad habit?
Look, we think high single-digit earnings growth is in our future for 2026. And, frankly, again, to your point this morning in Asia, go back to when the president was in the Middle East. deals were getting done. Deals are the lifeblood of what's powering the economy and specifically the AI-focused
so do you
economy.
take your terminal value out farther? What are the earnings today? Google, Meta, Facebook.
Microsoft.
It's Facebook in this room.
Yep.
Facebook, do you take your terminal value out for Fortress Zuck? Do you take it out instead of 3 years, 5-year study? Are you, because of this juggernaut economy, do you take it out to 7 years?
Well, you have to be careful because the countervail here is, again, we remember 2020 was a low in global bond yields, and likely at some point we are going to move higher in global bond yields, particularly since deficits around the world continue to expand. So that's part of the offset. But on balance, when you think about it, you hear the potential for productivity, your gains from AI. You're only starting to see it, but that is part of the long-term story that causes us, in our view, you don't get full AI adoption until 2028. So we're certainly looking out to there.
We got lots of, obviously, earnings today, but we also have the Fed today here. What are you going to be listening for from our chairman?
So this one seems kind of easy, and we're going to get the 25 cut. We're going to get a sort of no promises data dependency or lack of data dependency for December. But the bottom line is that the burden of proof is on the data to be either too hot in inflation or too hot in terms of job growth to not cut another 25. And, maybe we're not even going to get any more data.
So, I don't know. Maybe it's just recency bias with the headlines. It seems like they're seeing a lot of job cuts out there. And I don't know if it's material. I don't know if it's AI.
Wow.
Yeah, yesterday was a wow day. I mean, I don't know if this is AI related, if this is just seasonal, or if this is anecdotal. How do you guys think about the labor market, or how do you think the Fed thinks about the labor market?
So it's incredibly challenging. First of all, if you go to immigration policy, we don't know what the break-even monthly payroll adds is to keep the unemployment rate steady. It was 120,000 last year. Our people think it's closer to 60,000, but if you assume that migration is actually net negative, that number might be 20 or 30,000. Right. So that alone is an incredible problem.
I mean, folding yesterday, what was it, Paul? We had 34,000 and 14,000. I can't remember. It doesn't matter. The math is old news. If we have AI layoffs at these big companies, how does that change something as prosaic is, given the shutdown, we don't know, non-farm payrolls or the unemployment rate?
So here's the flip side of this, Tom. And David Weston did an amazing interview a few days ago with the head of Arizona State University, is that the transformative power of AI in the education field. Imagine this. We have a chronic shortage of doctors, a chronic shortage of healthcare professionals, because half the time they just don't want to commit to the payback period that it takes. Could AI actually shorten that payback period? Absolutely. Could AI make it more enticing for teachers where the attrition rate has been enormous in recent years to go back into those areas? It's the economy transforming, creative destruction, and you don't want to be on the destruction side. But it is how economies advance.
Get one more in here, folks. So Lisa Mateo, Paul Sweeney yesterday at BAM Mutual.
Oh, yeah.
Driven by AI.
Exactly right. Julian, is there something that screens well for you guys right now, whether it's sectors or factors? What gets your attention these days?
So we actually think that this is the week where you're seeing the end of mutual fund tax loss selling. And from our point of view, when you think it is, particularly in a year this strong, but there are lots and lots of stocks that are down on the year. A number of them are in the healthcare sector. Healthcare is at very depressed valuations, and healthcare is the focus of the shutdown. We like it.
20 seconds. Ed Hyman and your team, their recession call.
No recession. They were firm about it during February, March, and April.
Yep.
They continue to be firm about it. The call is for 1.5% growth next year. In my mind, that risk skews to the upside.
Julian Emanuel, don't be a stranger. We'll see you Monday morning, 7 a.m. as well. He's with Evercore ISI, their chief equity and quantitative strategist. He lifts the market, futures up 19 with our news. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We need to get briefed right now. Thomas Simmons joins us now, chief US Economist at Jefferies as well. I love the bottom of your note where you're AI, and all this. Cut to the chase. And Jefferies is, they're sort of like a hip firm. They're like involved in all this tech.
Sure.
How much is AI scaring the young kids or the older kids as well, the 60-year-olds? Is it a revolution like 1995 in the internet?
I think it eventually will be, although I'm not particularly sure that it's there just yet. I think that it's an easy kind of scapegoat to look at AI and say, oh, all of these firms are probably not hiring young college graduates because they have chatbots that do their job, or they have coding resources that replace all of these IT focused majors and whatnot. I think it's actually significantly more risky for older folks, right? So like if you were, for instance, a professional who did a lot of photo editing, I mean, that's been a pretty democratized technology in terms of how AI has been kind of put in your pocket with your cell phone. So I think it's more in terms of like consumption of services on the consumer end. We see less demand for very specialized services. And I imagine that, as people progress through their careers and they get kind of close to the end of them, then the issue is more so that they kind of, their runway is a lot shorter in terms of when sort of how much more time they thought they had before retirement and that sort of thing.
So given that background there on the labor market, there is obviously Fed focuses on the labor market, focuses on price stability, inflation. Mm-hmm. How do you think they're going to proceed here today? What do you think the message Fed Chairman Jay Powell would like to get across today?
I think that the message is pretty much unchanged, really, from where it was after Jackson Hole. I mean, I think that there was a sea change in the sort of perception of how healthy the labor market was. You referred to this curious balance of how surprising it is that sort of demand and supply in the labor market come down at the same time. And then very shortly afterwards, you see data that suggests that, well, maybe it isn't quite as imbalanced as it maybe appeared to be earlier in the year. And nothing that we've seen since then has really, kind of challenged that narrative. I think that it's one thing to kind of look at the labor market and say, well, we're not in the midst of some sort of collapse, some sort of like really, spiraling weakness. However, I do think that if you look at the history of labor market data, economic data in general, equilibria tend not to last forever, right? So like, it's nice that we're at this balance point. Is the risk that from a very balanced point, you reaccelerate to something quite strong, or is it probably more balanced towards the downside where things kind of start to slow down?
We had Robert Kaplan in yesterday of Harvard Business School, Goldman Sachs, the former president of the Fed, and we spent a good amount of time talking about retraining in this bargain that we blew it on clothing industry, the clothing industry of the Carolinas decades and decades ago. At Jefferies, do you see a dislocation of labor now and coming forward?
Jefferies tends to run pretty lean. So fortunately, I think that our, kind of corporate culture is aimed at making sure everybody is kind of utilizing technology as much as possible. We're pretty careful about it. I imagine most other competitors of ours are as well, right? Obviously there's information security issues that you want to make sure you have buttoned up before you just kind of dump out this technology to everybody. But it's always a risk, right? I mean, whenever we've had relatively or revolutionary changes in technology, part of the problem is that it looks like it's going to be this huge productivity boom that you get from it. Eventually, in the long run, you more or less do get that. But in the meantime, you have this kind of messy period where people waste a lot of time kind of trying to figure out how to use it. And it ends up being kind of an investment in productivity where it's down for a little bit before it comes up. So I don't get the sense that we're, necessarily looking at this as like, oh, we will never need to hire more people. I think that that's going to be a monstrous mistake if businesses actually do that because, it's just a kind of law of the universe that your labor force ages every day. And you need a talent pipeline to continue to fill in for people who are moving on for all sorts of different reasons, whether that's retirements or pivots to other things.
How are you viewing inflation out there? I think a lot of folks, myself included, are pleasantly surprised that we haven't seen higher level inflation that may have resulted from tariffs.
Right.
Haven't really seen it in the numbers here. How do you guys view that?
Early on was really confused about how to interpret the whole tariff thing. I think that, most of folks in my profession were, either suffering for some righteous indignation about how silly and kind of, misdirected the policy is. But that's not for us to debate. Really, it's just trying to figure out what the impact is. Right. And, we've seen a lot of price increases in a lot of different goods and services for many years. I think a great example of something that's really kind of illustrative of the whole situation is in auto and home insurance, right? If your auto insurance rates rise, you're pretty much immediately going to switch. You don't get utility from like the service that one of these, insurers provides you on a day-to-day basis. You need them maybe 3 or 4 times in your life, hopefully fewer than that. So there's a first mover disadvantage amongst the insurers to raise their rates, right? Like they would say, we'll try to capture market share from people who are getting away from the companies that are kind of forced to move with prices. I think that we're going to see that with goods too. I mean, like they're very substitutable across a number of different vectors. Right. And, to this point, we haven't really seen much in the inflation data that's shown that prices have risen significantly. I think it's kind of crazy to look at 100+% tariff rates on China and then say a 9/10 increase in like window coverings is the result of that.
The heart of the matter is, are we, the phrase that I'm using more and more now is a decline in purchasing power among a huge body of Americans. Okay, within the tariffs and the debate, how do we withstand prices? And the research so far is we're accepting higher prices, right?
I think there is enough of the consumer base that is accepting higher prices, right? Like I think that we focus a lot on people who are struggling, appropriately so. There's policy action that needs to be taken to try to help people out. But like anyone who bought a home or refinanced their mortgage before 2020 has not suffered any shelter inflation in 5 years, right? They've actually had their purchasing power increase over that whole time. And I think that that's one of the key reasons why we've seen the consumer writ large done so well here. And I think that businesses will probably focus on that and say, hey, if I'm charging a lot for a frivolous option on a car, for instance, maybe I can bump the price of that quite a lot while keeping the base price lower so the broad consumer doesn't suffer the same kind of inflation pressure as the ones who are sort of better able to accept those prices.
How much of this consumer boom that we have, Atlanta, I don't even know if they're doing Atlanta GDP now, but let's call it 2.5% plus real GDP. Nominals 4, 4.4, 4.8, whatever it is. How much of that do you calculate as a wealth effect?
A lot. I do think that it's...
Lisa, a lot doesn't cut it on a Wednesday.
You want a number? 85, 90%? So
90% pop is wealth effect.
When folks ask me what my biggest sort of concern, downside risk, thing that keeps me up at night sort of thing is, my concern is that we're going to get some sort of big decline in asset prices that I think will crush the consumer in the aggregate overnight, right? Like I do think that there's reasons why we see kind of weakening participation amongst different groups in the labor market. Part of that is because they've made enough money or they have enough assets that they can retire early or reduce their workload or that sort of thing. That changes very quickly if prices kind of, enter into a very nasty sort of negative spiral. So it's not so much that I think people are saying like, oh, my portfolio went up X% overnight, I can spend that much more. It's more so like, how comfortable am I such that I can make some more, I have more flexibility in my spending choices because of how well I'm doing with my assets.
What's your GDP 12 months forward, real GDP? Okay, 2-ish?
I'm a little higher than that. I think we're closer to like 2.5. I think
You're killing me.
Yeah, well, I mean,
have we ever seen this optimism from Jefferies?
Exactly.
I've always been an optimist. I am more amongst the most optimistic economists out there, I would say. But I think that it's underappreciated on a couple of different fronts. One, wealthier households are actually going to get a tax break with the big increase in SALT deductions.
We just covered that with Alicia.
Yeah, everybody in this room, I think, is kind of aware of that. But I also think it's underappreciated that we actually have much more certainty on fiscal policy now than we would in previous years.
Because of tariffs.
Well, tariffs are, they're kind of in the rearview mirror. Like, I think the kind of range of outcomes is narrower, but also just the investment incentives in the tax structure. It's not that long ago, several years in the recent past, where the IRS was like reprinting tax forms on New Year's Eve because some tax law had just been passed at the 11th hour. We've known the kind of broad strokes of what the policy is going to look like since Independence Day. And I can't remember the last year we've had something like that where there's been enough time for business planning for next year. So I think that we'll get some dovetailing between stronger consumer and also business investment.
Thank you, Thomas Sims. Really appreciate the brief with Jefferies there. A real dose of optimism moving forward. And we do that on this Fed Day as well. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Is John Mowrey. The last time he was in was really interesting about his Texas and, just the boom that's out there as well. How do you respond to people who say it's not a boom? It's not a technological productivity-driven moment that we're in.
Are you talking about Texas or are we talking about the stuff?
Montana, Texas, New Jersey. I mean, to me, there's a lot of people out there doubting what we're living.
Well, I think that, if you look at what's going on in the markets, a lot of things are being driven by earnings, and that creates stability. I think that's been one of the biggest reasons we've seen some of these mega compounders continue in the marketplace today. And I think that China is a really interesting component of this because it has a lot of these mega compounder companies trading at much lower multiples. And fun fact, we're almost at Halloween. Since Halloween of 2022, when the market bottomed, the Chinese index is beating the S&P 500. That's with Nvidia doing everything it's done. So I think there's some really interesting opportunities out there. And I want to talk about a handful of them. But I also want to talk a little bit about QT at some point today, because that's a topical.
I mean, that's something, all I care about is what the Fed's going to do with rates. But it is, what are they doing with their balance sheet as well? How are you thinking about it?
Yeah, let me say, I was actually thinking about coming on air today, and I was going through things I wanted to discuss. And it occurred to me that we have a third mandate for the Fed.
Okay.
And the first two, unemployment and inflation.
Yep.
But the third mandate is inherited, and that is managing balance sheet liquidity. Post the GFC, they entered into this new world era where they have to continually monitor what they're doing on their balance sheet. And this is really a new mandate for them. And if you look at what happened in 19, those reserves on the federal balance sheet dipped lower, below that $3 trillion mark, and that created real scares in the repo market. Yep. We're seeing the similar thing today. Why is the Fed all of a sudden stopping QT? What is the reason for that? Well, it has to do with the ability for banks to lend money in that repo market, and that reserves on their balance sheet close to that $3 trillion mark is a big deal. So the reason I say this is because we live in a world now where the Fed's always going to be focused on what is on their balance sheet and how much, and if they're doing QE or QT. I think that creates a real dynamic at play in the financial plumbing and in the financial markets. And one reason I like regional banks, they will benefit with QT coming to an end, because that will make it easier for them to lend money, and that will produce a pop in their NIMs.
It's a general statement. The banks are behind, right? In this melt up, the banks are behind. Right? How behind is behind?
They're really behind. They're flat year to date.
I know, but on a PE or price to book, the stuff you look at, measure the behind that they are.
Tom, you can get regional banks on a price to book basis at the same level that they were in May of 2023 when you had the SVB and First Republic blow up. They're cheap.
So what's the catalyst to make that look Nvidia like?
Well, three things. The first, I would mention, I think that the stopping of QT is a real tailwind. Deregulation, that's a big component with what's going on with the Trump administration. So they want to continue that. We're seeing M&A activity already. So, you've seen Cadence get purchased recently. So by Huntington Bank shares. So I think you'll see more M&A. But I think the main driver is two big pieces: valuation and earnings growth. You've got earnings growth coming out of these banks in the high teens, sometimes even 20%.
Right.
So steeper yield curve, low valuations, fast earnings, deregulation, and then the stopping of QT, all those things coalesce into a pretty interesting basket.
John Mowrey with his Chief Investment Officer at NFJ. We welcome all of you across America. We welcome you in Texas, where he is from, and we say good morning on YouTube as well, worldwide. Good morning on the Pacific Rim, where Tyler Kendall is. In Korea, good morning and good night, I should say, in India as well. Thanks for your attendance on a daily basis. On YouTube, subscribe to Bloomberg Podcasts. Paul Sweeney.
John, you mentioned China here, and we've got President Trump meeting with President Xi tomorrow, presumably in South Korea. What is your China call here?
So we've been very bullish on China. We got very bullish, as I mentioned, back in 2022. We've stayed long China. I think actually in our international and our emerging market funds, we might be the top allocators within that region to China. Yeah, so we're really bullish there. What I would say is that the fact that they're meeting is a real positive. There's definitely been, some hand grenades thrown back and forth between the two. I think that the last time they met was back in 2019. That was for a brief period in Japan, and before that it was at Mar-a-Lago. They're not going to meet in Korea without some positives to share for the market. The reality is President Xi knows that he needs to continue to strengthen his economy. He wants to open up some of the pathways for communication. So I think that there are real positives that could come out of this. EVs are one thing they're going to tackle. Rare earths are another. The rare earth thing is funny because they're actually not rare, as we know. They're just refined in China. But these are real levers. And the reality is we need the two superpowers to work together. So I think this could be a real catalyst. But to be quite candid, I think the main catalyst is you've got a lot of earnings growth coming out of China, really low valuation, and they're a sleeper in the AI trade. And if you look at what's going on in the US, I mean, Jensen Huang came out this summer and said that DeepSeek and Tencent and Baba, he said their models are as good as ours. And I don't really think that Americans are fully pricing that in. And I think there was a lot of scare, maybe several months back about delisting at ADRs. That has not come to fruition. I do not think that would be good for either country. The reality is China wants capital. She wants money to flow into China, and he wants investment from the U.S. And Trump knows that he needs to work with Xi to find a path here. Fentanyl is the big wild card. If they find a way to talk about that and restrict some of that coming to the U.S., that'd be a big win. So this is probably the beginning of meetings. I would expect they meet again, hopefully around Christmas time, maybe Mar-a-Lago. Maybe we get another meeting in Florida between Xi and Trump.
Do you model, and the prism here for John Mowrey, folks, is Texas, which we all agree is its own unique separate enemy. I needed a passport to get through the George Bush Airport in Houston.
Sure.
Yeah, they had customs.
I think it's the 9th largest economy in the world.
Is it?
I think so.
Thank you.
It's big. It's really big.
So if we do this China AI thing and all the happy talk and Trump means Xi and all that, does that mean the Chinese economy actually lifts up and they get back to a real consumption that's been missing?
I think it's very possible. I really do. I think that if you look at what's going on, Jack Ma coming back was a big deal. Pony Ma has come out. He's the CEO of Tencent in support of some of the moves that Xi is making. So I think that Xi can take a page from the playbook of Trump, that you need to be working with your top leaders of the biggest companies, the biggest employers, in order for the country to thrive. So I think that Xi is doing that. He did clean house in his cabinet recently. That's an interesting move that he made. So he definitely has stacked it with people that are aligned with him. But if I'm being honest, it's no different than generally what we see here in the U.S., people trying to put people around them that they think are aligned with them. So I do think that we have some upside here.
We're now emulating China. Okay.
Well, program note on that. Elizabeth Economy with us here recently. And, she's so subtle with me. Tom, shut up and read this book.
Sure.
I mean, she's so gentle about it.
Yep.
And I'm actually reading a book on the Chinese military because Dr. Economy said, hey, stupid, read it.
Absolutely.
I don't have a report on it yet, but, like you say, they replaced generals and admirals and such.
My proxy for China has always been Alibaba, and the stock's up 110% year to date. So my boy Joe Tsai getting it done there at Alibaba. You guys are value investors. How do you define value?
So we look at value through a few dimensions. The first is based on valuation relative to a company's history, the market and peers, but I will tell you that the peer group is the real crown jewel of our research because peers are not homogenous. Think about the housing market, for example. If you look at homes, in New York or California, you really have to create homogenous peer sets to determine if a house is expensive or cheap. It's not just, every house on your block is not a comp. So if you take regional banks, you can't say they're all comps because some have wealth management, some are tied to interest rates. So you need to really have a statistically tight group.
At NFJ, do you have a single best buy? Are you allowed to say, this is our single best buy?
Well, that would be hard. If I knew a single best buy, I'd have a one-stock portfolio, so we run diversified funds.
I understand that.
But I will tell you that Alibaba is our top weight in our international.
So let's go there. Paul's really on top of this. Well, give us 20 seconds. Alibaba, go.
Okay, so Alibaba, first thing I'll say is they have made a commitment to do over $52 billion in cloud infrastructure over the next 3 years. That's an enormous commitment to AI. You're trading at some of the lowest valuations on an EV to EBITDA basis over the last decade. We have a long way to go. They've been increasing their dividend. They now pay a dividend. Alibaba went from a growth stock to a value stock. So you've got dividend growth. You've got tons of cash on the balance sheet, big investments in AI. I think the future is really bright for these guys. This is a combination of Amazon, Nvidia. You have all these components tied together within the Baba infrastructure. Cloud infrastructure, chips, models, retail.
Was that good enough?
That covers it. I
see
you. You're on with Robinhood right now. I can
Absolutely.
see you.
He's buying some Baba. He's buying some Baba.
I've been long Joe Tsai for a long time.
Can I say one thing about? Can I make one comment?
Quick.
Taiwan is the big wild card. What is going to happen with Taiwan? If we looked at the playbook for Hong Kong, they took it back and they did it slowly, but they did take it back. I think that's going to be the play very slowly.
John, thank you. John Mowrey with us, Chief Investment Officer, NFJ there. Stay with us. More from Bloomberg Surveillance coming up after this.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
In 2006, they found a tree which is growing to the sky. It's out in California. It's a redwood. It's a secret where it is. They want to keep the idiots away from it. It's over a football field tall, which is nuts. It's our example of trees to the sky. Mm-hmm. Alicia Levine knows that earnings, revenues, the stock market, Nvidia, it doesn't grow to the sky. Head of investment strategy and forest wisdom at BNY Wealth joins us this morning. How close are we to redwood height in this stock market?
So I don't think we're at redwood height because I do think the earnings are delivering and coming in better than expected. And the multiple that we're at today, now we're at 23 times. But for most of the year, we were at 22 times forward earnings, which is where we were a year ago when we worried about expensive markets. It's the earnings that are driving this market. And so I don't see redwood to the sky. I see a very careful path upward climbing that tree.
And out of the Fed, we're doing differential equations today. Okay, let's look at a quadratic glide path of we're spending all this money on CapEx. There's another curved line, which is someday it's going to pay off as well. Where on the x-axis do we learn if AI pays off if you've got quadratic glide paths crossing at some point?
Look, it's a great question. I would say it is a market matter. I'd say you need to have visibility into the next 18 to 24 months here. Fair, right? Like it can't be 5 years, right? If it's 5 years, you're going to wind up with a market that's going to reset at the top here. So I think it has to be 18 to 24 months. This is how we invest our client capital. We do 12 to 18 months forward. That's probably the right time horizon. That's why we use forward earnings on the S&P, not the trailing. I think the trailing is irrelevant. It's the forward. It's always looking forward. So if you have a monetization of the CapEx within the next 18 months or so, then the market's fine. Then you're okay.
If we don't hear that in the conference calls, Carol and Tim will be on. Like, do we go down on the Dow? Do we go down 4,000 points?
So it's no. I mean,
the mark?
I don't think it's today. I don't think it's the earnings call. It's 48 hours is so. Let's call it rich. It's a rich 48 hours. You know, it can be up for 2 days straight just on what could affect the markets. It's not today, but it has to be some visibility. And as you know, some of the companies that have actually shown to monetize some of their investments earlier have done better than others. Sure. And where there was a question about it, I can't talk about specific names, but you saw the stocks languish for a year or 18 months because there's investment with no payoff. So it is very clear that there has to be some, ROI here coming down to the bottom line.
How do you think about the one big beautiful bill? A lot of folks are saying that's going to be a real driver for growth in 2026. We're worried about tariffs in the short term, but how about in 2026 with some of the legislation that has passed?
So I think it's a huge driver. It largely offset the drags for tariffs on the corporate sector in the aggregate. And I'm saying that slowly and clearly because not every company, for instance, a furniture company, is going to feel the effects of the one big beautiful bill. But overall, the tax consequences and the cash flow nature of investing offsets the drag from tariffs. It's enormous on the corporate sector, which is this year, which is why earnings are so strong. We don't see the effects of tariffs. And in the first quarter of 2026, you have the consumer support coming from the tax code. So refunds from the IRS, February, March, and April. So you're supporting the lower end of the consumer that are available to get these refunds while you're supporting corporates. It's huge.
Well, Paul, to me, that's the question of the day that you asked. I mean, to me, it's been underanalyzed.
Yep.
It's been it's not in the zeitgeist here as well. And you just look at it as one big stimulus. I mean, the big, beautiful stimulus, I think, is how you got to
I think the more important point here is when you think about modeling this, it's been very univariable. What are the effects of tariffs on an economy? Well, that's fine, everything else being equal, but everything else is not equal. You have, it's a dynamic model. There's fiscal policy as well, coming with the unusual trade policy for the country. And actually, it's offsetting it and encouraging CapEx.
20 seconds. If we get lower interest rates, there's a univariable ambiguity there. We can have a positive construct with lower rates, can we?
Absolutely. Absolutely.
Are you okay there?
I'm pretty good.
I'm just reading Fabosi here, trying to keep up with Alicia Levine.
Look, we lower rates, higher market, everything else being equal, as long as inflation doesn't get to 4%. Okay, so the market's accepting 3%. The Feds restarted the cutting cycle at inflation at 3%.
Michael Barr's taking notes. Alicia Levine, thank you so much. With BNY there on the lift of the market, let us make note. She has said, participate in equities. She has been correct.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.